You could be keeping $76,000 of your $100,000 salary, but depending on where you live, you might only take home $69,000. That's $7,000 per year, $210,000 over a 30-year career. Or you could be keeping $68,000. That's $8,000 per year. You're losing to state taxes alone. The difference isn't effort or skill. It's where you live. It's where you live. One state taxes you $2,600 in state income tax on that six-figure salary. Another takes $10,000 over a 30-year career. That's the difference between an extra $240,000 in your pocket or watching it disappear to government. Most people never realize this is a choice they control. Today, we're going to show you exactly where your money goes depending on which state claims you as a resident. In a moment, it'll reveal the 5 states where a $100,000 salary actually feels like $100,000, and the 5 where it feels like you're earning $65,000 instead. Let's start with the invisible baseline that affects every single American equally. No matter where you live, the federal government takes roughly the same cut for someone earning $100,000 as a W-2 employee. Federal income tax runs about $13,355. Add in Social Security and Medicare, and you're looking at another $7,650. That's $21,000, gone before any state even touches your paycheck. Now here's where it gets real. Most people think taxes end there. They don't. Every state then decides independently how much more they want from you, and the spread is staggering. Louisiana just took a major move in January 2025. They flattened their tax structure into a single 3% rate on all income above their standard deduction. For a $100,000 earner, that's roughly $2,625 in state tax. South Dakota and Texas went further. They don't tax income at all, $0. Not a dime. But before you pack your bags for Houston, there's a complication we'll come back to. This is the part that catches people off guard. In a moment, I'll show you why the best state for taxes might actually be the worst once you factor in the hidden costs that most people overlook entirely. California sits on the opposite end. At $100,000, you're paying 93% state income tax, nearly 4 times Louisiana's rate. New York City residents pay that plus an additional 39% city tax on top of the state rate. Hawaii runs 825% effective. Vermont hits 68%. By the time you include local taxes, sales taxes, and the property tax component, some states take nearly $10,000 more per year than others. That's real money. That's a car payment. That's an emergency fund. That's the difference between feeling secure and living on the edge. Reset. Pay attention to this part. The gap between the best and worst isn't some fringe edge case. It's nearly $10,000 a year for an ordinary earner at an ordinary income level. Let me walk through the 5 states where your $100,000 actually stretches furthest. Louisiana leads here. And not for the reason most people think. Before 2025, Louisiana's tax code was a labyrinth, multiple brackets, deductions, phase-outs. It was the kind of tax code that generated paperwork fatigue and uncertainty for people trying to understand what they actually owed. Then Louisiana simplified it. One flat rate, 3% done. For someone earning exactly $100,000, that's $2,625 annually. Your take-home from federal and state combined is roughly $76,370. The trade-off is sales tax. Louisiana charges 445% state sales tax plus local variations. If you spend $50,000 annually on taxable goods, that's another $2,225 in taxes spread throughout the year. But here's where the psychology shifts. Income tax feels like a punch because it happens all at once, every paycheck. Sales tax feels invisible because it's distributed. Most people perceive the income tax relief far more acutely than the sales tax burden. 3% state tax, $87,500 taxable income =, $2,625 annual state tax. Results vary based on consumption patterns and property taxes by parish. South Dakota offers something different. No state income tax whatsoever. On that $100,000 salary, you keep the entire amount after federal taxes. That's $2,625 more per year compared to Louisiana. Your take-home is roughly $78,995. The catch is that South Dakota makes up for it with a 65% to 725% combined state and local sales tax. If you spend conservatively, $30,000 annually on taxable goods, the sales tax burden is only $1,950 to $2,175, leaving you ahead of Louisiana. But if you're a spender at $60,000 in annual consumption, Sales tax jumps to $3,900 to $4,350. And Louisiana's simpler math actually becomes competitive. Most people miss this element of their own spending. You can know the tax rates perfectly and still make the wrong choice if you don't know whether you're a $30,000 consumer or a $60,000 consumer. Texas and Florida operate on the same principle. Zero state income tax. That's $0. Texas charges 825% average sales tax. When you combine state and local rates, Florida charges 65% to 75%. Both states rely heavily on property taxes. Instead, Texas property tax runs about 16% of home value. Annually, Florida averages lower, around 0.8% to 12%, depending on county and whether you're dealing with hurricane insurance impacts. Zero state income tax equals $2,625 plus annual savings versus Louisiana. But property tax implications vary wildly. Here's the tension most relocation decisions miss. Texas has no income tax, but among the highest property taxes in America, someone moving from Louisiana to Texas for that $100,000 salary might save $2,625 on income tax, but lose $6,000 to $8,000 to property tax if they buy a $400,000 home. The math inverts. Now Texas isn't better, it's worse. Most states market their income tax rates. Nobody talks about property tax in those recruitment videos. Nevada rounds out the top 5 with another zero income tax state. It's less talked about than Texas or Florida, but it functions identically for W-2 workers. The sales tax is 685% combined, slightly lower than Texas property taxes, are moderate at 0.6%. Nevada has become attractive recently due to tech job growth in the Reno corridor, which matters because a tax advantage is only valuable if you can actually earn that $100,000 in that state. This is where the system reveals something important. The 5 best states for tax burden only stay best if you can actually work there, and if your life circumstances align with their tax structure. An unmarried renter in Nevada crushes a married homeowner in Texas. Same income, wildly different outcome. Now here's the twist. Most people miss this. California takes the crown for the worst effective tax burden. $100,000 income, you're landing in the 93% state tax bracket. That's $6,054 in state income tax alone. Add the state and local sales tax averaging 825%, and you're at $4,125 in annual sales tax on $50,000 consumption. If you own property, California's 1% property tax applies to homes that often cost $800,000 or more in job centers. That $8,000 property tax bill hits whether or not you intended to buy expensive real estate. Your total tax burden in California lands around 31% of that $100,000 salary. Your take-home drops to $68,815. The difference between Louisiana's $76,370 and California's $68,815 is $7,555 per year. Over a 30-year career, that's $226. $650 in extra taxes paid to California for earning the same income doing the same work. New York City presents a different problem. The state tax itself is 585% on $100,000, which isn't catastrophic, but NYC residents pay an additional 3,876% city income tax. Suddenly you're at 973% combined income tax, higher than California's rate, and California has the highest state income tax in the nation. Add NYC's 8,875% sales tax, and the state property tax of 165% on expensive apartments, averaging $500,000, and you're paying roughly 33% of your income in state and local taxes. The trap here is psychological. People know California is expensive. They expect to pay. New York City sneaks up on people. It presents itself as an economics hub, a cultural center, a place where the salary justifies the cost. But the math reveals that your actual purchasing power at $100,000 is lower in NYC than in California. Reset. Here's what nobody tells you about high-tax cities. Hawaii comes in third for worst burden. And it's revealing because Hawaii's income tax rate of 825% is driven by a unique factor. Isolation. Hawaii has a small tax base, fewer than 15 million people funding state services across islands. The income tax burden is high relative to other states, but Hawaii's saving grace is the lowest property tax in America at just 0.3%. If you're renting, Hawaii for a $100,000 salary is tolerable. If you're buying, Hawaii becomes surprisingly competitive with East Coast states because the property tax relief is so substantial. Vermont and Connecticut round out the worst 5. And they're included because property tax transforms the ranking. Vermont's 68% income tax seems manageable until you layer on 11% property tax. Connecticut's 55% income tax looks better until the 21% property tax kicks in, among the highest in the nation. These states are less famous for tax burden than California or New York, which is why people underestimate them. The quiet tax pressure creeps up on residents annually, year after year, without the cultural awareness that comes with California's reputation. One state alone, Connecticut, can consume $13,042 in combined state and local taxes on a $400,000 home purchase, while Louisiana extracts only $4,825 for the same income and property. The difference is more than $8,000 annually on the same earning and living situation. This is the part where the system reveals its structure. Income tax is visible, and monthly property tax is annual and compartmentalized. Sales tax is distributed across purchases and feels diffuse. Combined, they're devastating. Separated, they seem tolerable. Pattern interrupt. Most people making major life decisions about relocation focus on one tax variable and miss the other four. Let's put numbers to the full picture. If you earn $100,000 as a W-2 employee and buy a $400,000 home as a primary residence, here's what the states actually cost you annually. Louisiana, $2,625 income tax plus $2,200 property tax equals $4,825 total state and local. Texas, $0 income tax plus $6,400 property tax equals $6,400 total state and local. California, $6,054 income tax plus $4,000 property tax equals $10,054 total state and local. New York, $4,946 income tax plus $6,600 property tax equals $11,546 total state and local. Connecticut, $4,642 income tax plus $8,400 property tax equals $13,042 total state and local. Add federal taxes to all of these, $13,355. You see how dramatically location shifts your actual purchasing power. The difference between the best and worst states isn't $2,625. It's $8,217 annually. That's a $246,510 spread over a 30-year career. Here's what complicates this further. Local income taxes. Many cities layer their own income tax on top of state and federal. Philadelphia adds 387%. Washington, D.C. adds 895%. Columbus, Ohio adds up to 25%. New York City's 3,876%. We already discussed. This means a Philadelphia resident earning $100,000 is paying 307% state tax, plus 387% city tax, totaling 694% in income tax alone. That's nearly as high as California's rate, and California is supposed to be the outlier. When you factor in local income taxes, the traditional low-tax states list collapse. Most people think about relocation decisions using incomplete information. They hear Texas has no income tax and assume Texas is cheaper. They don't run the property tax math. They hear California has 93% income tax and assume California is the worst without comparing it to New York City or understanding how property tax distributes the burden differently. The decision requires calculating your full tax picture, not just one component. Here's the human reality: relocation decisions happen during uncertain moments. A job offer, a promotion, a pandemic shift to remote work, a relationship change. During these moments, most people grab the first piece of tax information they encounter and build a decision around it. Then they move and discover, 6 months later, that they miscalculated. The property tax was higher than expected. The sales tax on groceries and gas is worse. The utility costs in the new climate are shocking. The money they thought they were saving evaporated. This is where the paperwork burden adds another layer of friction. Many states require you to file taxes in multiple states if you worked in one state but moved to another mid-year. The complexity of understanding your actual tax situation creates a decision-making barrier. Most people avoid it. They take their best guess and adjust later. Pattern interrupt. The states that make the most money from relocation decisions are the ones that hide their true tax burden in different categories. Here's the clean way to think about it. If you're making a relocation decision based on taxes, you need to calculate first, state income tax on your specific salary in that state. Second, local income tax if applicable. Third, property tax if you're buying, based on actual prices in neighborhoods where you'd live. Fourth, sales tax applied to your consumption patterns. Not theoretical consumption, but your actual spending. Fifth, any other taxes that apply to your situation. Vehicle registration fees, utility taxes, business taxes, if self-employed. Then add them all together. That's your actual tax burden, not the headline rate you see in clickbait comparisons. The other factor that deserves mention: tax law changes constantly. Louisiana's shift to a flat 3% rate in January 2025 is exactly this kind of change. A state might be high taxed today and moderately taxed next year if new legislation passes. Relying on 2024 tax data to make a 2026 move is already outdated. You need current information from official state revenue departments, not tax calculators that lag by months. Before taking any action based on this information, confirm with a qualified professional ACPA who understands multi-state tax situations, can review your specific circumstances and guide you correctly. Tax law changes frequently. Your filing status, dependents, investment income, and business structure all change the math substantially. This analysis assumes a single W-2 filer with no dependents, no investment income, taking standard deductions. Your situation may differ dramatically. Also understand lower taxes don't always mean lower cost of living. Texas has no income tax, but some of the highest property taxes, which partially cancels the advantage if you're buying Hawaii. Has high income tax but very low property tax, which helps homeowners. California has high income tax and expensive housing, offering no offsetting advantage. It's genuinely expensive. Louisiana has low income taxes and low housing costs, making it genuinely cheap. The tax structure alone doesn't determine your quality of life or financial outcomes. Factor in salaries in that state, job market health, and your personal lifestyle entirely. Reset. The best state for you depends entirely on your specific situation, not the general ranking. If you're remote working for a company headquartered in one state while living in another, some states now require you to file taxes in both. This is a recent enforcement trend that catches remote workers off guard. Verify with your state's revenue department before assuming remote work frees you from state taxes. If you're retired or soon to be retired, tax treatment of retirement income differs radically by state. Some states exempt pension income entirely. Some tax it partially. Some tax it fully. This analysis is strictly for W-2 earned income and doesn't apply to retirement planning. That requires separate consideration. Here are 3 practical takeaways from all of this. First, your location determines your taxes more than your income does. Second, effective tax rates matter more than marginal rates. Third, you need a complete picture before deciding. If you're considering relocation and want to calculate your specific situation, verify current rates directly with your target state's revenue department website. Tax Foundation also publishes detailed state tax comparisons that are regularly updated. A CPA consultation costs $200 to $500, but can save you thousands through proper tax planning and prevent costly mistakes based on incomplete information.